I will go ahead and call this meeting to order. I don't think there's anybody public. Is there any board communication? If not, Cindy, do you want to?
Sure.
Cindy can give a brief update.
Hello, everyone. I think you have here. You'll notice that, well, you won't notice because you don't have the June of 20, but we had an increase in revenue, and that was mainly attributed to, we had a change in fair market value, which was a positive. If you recall, in June of last year, we were at a loss in change of fair market value. And the expenditures have gone up some, but it's mainly attributed to an increase in pensions because we have had an increase in the number of retirees. I think there's maybe about 19 this past year. So total fund assets have increased from 126 to 153, or about $27 million. So I just thought it would be nice to give you the comparison from June to June.
We expect that every time now.
Yes, we do. Well, those that do that are here.
Anything else?
No, that was it. That's all I had. If there are not any questions. Okay, thank you.
Hey, Cindy, could you, or John, could you, sorry about that.
That's okay.
Could you, if you sent that out in an email, I missed it. But if you haven't, could you send your report out in an email?
Okay, it was part of the packet.
Oh.
Do you mean this report, this page?
It's the second page of the packet.
Yeah, and that's just the June of 21. And I just, because it's the end of the fiscal year, I wanted to just do the comparison June to June. That was not included in the packet.
Okay, understood.
All
Okay.
Thank you.
All right, thank you.
Sorry if I make anyone dizzy. Okay. Hopefully everyone's read the minutes from May 13th, and I would entertain a motion.
So moved.
I just have one correction.
Okay.
The meeting date was changed. I don't know if you need to change that on the minutes.
Say that again.
On page 4, the next meeting was changed till today, so I didn't know if you had to reflect that in the minutes.
No, I think that was what was.
That's what was said at the
At the
time.
meeting,
So I
yeah.
think that's
Oh, okay, gotcha. Okay, I so move we move the minutes.
For a second.
I'll second, Jason.
Okay. Let's say I've never seen a motion for minutes to fail. There's no other discussion. All in favor, say aye.
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 Okay. Motion passes. Authorization of payments from retirement funds for retirement benefits. We have a series of them. And which is all one motion, as a reminder, unless there's an issue.
I'll move all of the authorizations as presented.
Is there a second?
I'll second.
Thank you. Any discussion? If not, all in favor, say aye.
Aye.
Aye. Against, same sign. That passes unanimously. Hey, SCI investments, discussion of quarterly report. And if you can, for anybody presenting today, if you're, will you on each page tell us which page you're on so that we can follow along?
I'll be happy to do that. Good afternoon. My name's Roger Messina. I'm the executive in charge of our business. I've been with SCI for 29 years. I am filling in for Pat today, so hopefully I can live up to his standard. So I have a short deck that John Dwyer will drive for me. John, if you wouldn't mind going to the executive summary, which for everyone is page 3. It says Town of Groton Executive Summary. I think the first thing, and certainly ask questions as I go through this these handful of slides. The first thing we always like to remind everyone of is the governance model, and that we do provide a very strong approach by overseeing both the managers that we hire inside the funds and all the fund holdings, and we're responsible on behalf of the committee. The committee has delegated that to SEI to oversee the managers and hire and fire them. You're well diversified, and I'll show you the benefits of that in a couple minutes. You have exposure to 7 different equity classes, fixed income, and real estate. And there's 15 underlying managers that operate on your behalf. We work closely with the board in Sageview to ensure that the recommendations that we propose are fully vetted and everybody is comfortable with what we're doing. So I think that's a very good partnership, and it provides a better outcome working together in a collaborative fashion. I mentioned the diversification. We believe you should be well diversified. You never know what area the market's going to do well, whether it's geography or the size of the stocks or the type of stocks. But we want to be well diversified. Those are our key tenets and the way the model has been working for the town. The good news, and I'm very grateful that markets continue to cooperate. We have, as of 6:30, achieved a return for the 1 year of 25.5%, 12.6 over the trailing 3, and 11% for the trailing 5. Who would have thought 1 year later we'd be talking about a 1 year return of 25+%? We're certainly grateful for what markets and having the fortitude, and the committee should be congratulated for staying invested through the downturns, and a very difficult downturn, let's be honest, where we had the pandemic, the work from home, the demand destruction, certain segments of the economy, but being patient and allowing the long term to work has been a successful strategy. So if we go to the next page.
Roger, real quick, just to stay on that page for a second, just to note that the actuarial assumption rate was changed last meeting to 7%. The board unanimously agreed to that, effective with the July 1st, 2021 valuation. So I think technically this is correct since this carries through 6:30, but just wanted to note that.
Okay, I appreciate that. We'll duly note that for our materials going forward. So slide 4 just gives you the asset values by month and those returns. So as of the end of June, we're up 153.5 million versus the end of March, 147.8, let's call it. So good increase in assets. Second quarter was up 5.5%. Year to date, up 8.5%. And again, as I mentioned, the 1 year, 3 year numbers are outstanding. Having this diversification in both US and global, large cap and small cap, worked quite well. Having diversification in fixed income was extremely beneficial, the exposure to high yield. So with that, I'll just go into a couple more charts and answer any questions. If John, you would go to slide 7. And those of us in the investment business love charts. You grow up on charts and using them to help support your thesis. And it's important because I want to be able to talk to you a little bit about what goes on below the surface. So I know there's a lot on this chart, but I want to point to the bottom left where it says value and growth. And this points to the notion of why diversification is an important tenet for what we do. So if you take stocks and you put them into 2 buckets, value stocks and growth stocks. So examples of growth stocks are, your Amazons, your Googles, growth tech companies. Value stocks, industrial stocks, consumer stocks, etc. So what you saw in the first quarter, when the economy was starting to open up, value stocks did exceedingly well relative to growth stocks. And so if you didn't have that exposure, you missed out. Well, in the second quarter, as you can see with the blue, growth, again, outperformed value. So you don't know when these things are going to happen. So you're better served by just having broad-based, inexpensive, low-cost allocations to value and growth. And the rest of this chart just talks to you about those sub areas of the market, right? And what's interesting here again is you would think on the far right, utilities would do well. Well, we're in an environment where, for whatever reason, utilities aren't doing well. So instead of trying to pick or time, it's better to be broadly exposed and let the markets and time work in your favor. So the next couple charts just are international and fixed income. I would move to, John, to the performance table, page 12. So this is from a governance perspective, very important. You will see that the inner ring is the targeted allocation, how much to equities, how much to real estate, how much to fixed. And the outer ring is your actual. So we want to make sure these are in line within the tolerance. And you see that they are. So from a governance perspective or process perspective, you can see we're doing that rebalancing work. The right-hand side is just a reconciliation table of cash flow, what your opening balance was, what your gains and losses were, and what the net cash flow is. So cash flow, obviously, inbound contributions, outbound, any payments or expenses that are paid out of the trust. And lastly, I want to go to slide 13, just give you a little bit more performance information. Here again, you could see total plan return on the top line, net returns in the middle, and then the index below. So you can see on the fiscal year to date, up 25.27, and the fiscal year to date index up 24.61. And then if you just follow that down, you could see the large cap index fund and the small mid cap fund, then the passive international fund, et cetera, all the way down. I want to point out again the value of diversification. If you look where it says total fixed income, core fixed income was up less than 1% in the fiscal year, 0.89. High yield was up 23+%. So it's good to have all these exposures, and real estate during this time period was up over 39%. So really good results. Committee should be applauded for the allocation and the ability to stay invested through the ups and downs and the emotions of the market. If you ask me my views going forward, I would say that I think things still line up for continued good markets, very low interest rates, not only in the US, around the globe, fiscal policies that continue to be very additive to the economy. And lastly, the fact that corporations, their earnings are very, very good. They continue to have growth and good earnings. So directionally, I think things continue to line up in a very positive fashion for both equity and fixed income. So I'll stop there and take a breath, answer any questions, clarify any information. Any
Anybody?
questions?
Anything, Cindy? Nothing here. Okay, going once, going twice.
Okay, well, thank you for your time. Appreciate it this afternoon, and we'll stand by and listen if there's any other questions that come up through the rest of the presentation.
Thank you, appreciate it. On to Sage View.
Thanks, John. Let's see, I think I can share my screen as well. Can everybody see that? Oh, wait, here we go. How about now?
Coming up, now it is, yep.
Okay, perfect. Okay, I'm gonna kind of follow up on Roger's, so the question is, where are we going? The looking backwards, echo Roger's comments on a great allocation. It really has helped to be diversified. Can never get it entirely 100% right. We wish we were more in the high yield than we were, but again, that's rear view mirror stuff. So the question ultimately is where do we go from here? And I think the real issue is inflation and where we go. So I'm on page 39 of the deck that was sent out. If you're going just from the Sageview deck, then it would be page 5 of that. So again, it's the issue is where does inflation take us and the impact that will have not only on the potential growth of the economy, but also interest rates as well. Because one of the ways you fight inflation if it gets rampant is to raise interest rates. That necessarily would not be a bad thing for the pension plan, because the rise in interest rates actually bring your liabilities down. And so as your assets grow, they can keep pace with liabilities. If the liabilities come down, we can continue the asset growth. That's the win-win. So ultimately, we're looking at how do we do that. So just this chart, as Roger said, we do love charts. Kind of looks at the inflation and as measured by CPI and core CPI over a long time frame, going all the way back 50 years. And you can see that headline CPI, a 50-year average of 3.9%. We really haven't been close to that, certainly over the last 10 or 20 years, hovering more along the 2% or under. But longer term, we've had a higher level of inflation. So is it possible that that we have a return to inflation? Certainly over the last year, we bumped through that 2% level, and we're closer to a 5% inflationary scenario, driven obviously by increases in energy, increases in labor costs, and as we try to rebuild our inventories, and the cost of materials, things of that nature. So the Fed believes, if we turn to page 14 of the Sageview presentation, page 48 of the Groton, the Fed believes that we're actually going to come back to a more normalized, what they're looking for, a more normalized inflationary scenario in the 2% range. There's a lot of debate whether that actually is attainable over the next several years. And that's something to monitor, and we'll watch very closely. Again, very, very much a labor shortage right now. Wages are going up, be hard to contain inflation in that scenario. That said, the flip side of that is we're becoming a more productive labor force. We're getting done more today, almost 3 times the amount of productivity in today's scenario than we were getting since the beginning of this century. So more productivity can kind of pull back on labor and wage demands. And I think one of the other things that'll be interesting to see is the cost that ultimately the corporations, the businesses have to go through. How does that change as a result of all of this? For example, as companies are looking at where they staff their employees, are they going to be spending as much on their building costs tomorrow and then in the next future years as they did in the past? Or are more people going to be working from home? Is that lower the overall costs? So very important to watch that, not only from an inflationary standpoint, but the impact that might have on corporate earnings as we go forward. So looking at it from the Fed perspective, are they correct? We're going to be pulling back from the rising inflation that we have here, or does that rising inflation continue, and the impact that might have on ultimately on interest rates? How is that important to you guys? Right now, you've got a funded status of about 81%, meaning that assets are about 81% of your longer term liabilities. That impacts on the cost to the plan. if we can increase that funded status, by, either having liabilities come down or assets grow, that certainly helps the funding status of the plan and ultimately the cost to the town of Groton. So we'll be, monitoring obviously the liability side of that, but also as we look forward towards the asset allocation, historically it's been a great allocation. Is that the same allocation that we want going forward? Or should we be looking, based on the next 10 to 20 years, should we be looking at maybe some changes? And so working with SEI, Mark and I will be bringing that to you, over the next quarter or two. And that may require, an extra meeting. We'll work with John on that, because that may be more than a 20-minute conversation as we look at different asset allocation scenarios. So more to follow on that, but extremely important in terms of where the future allocations may be based on, where the future inflationary scenarios and interest rate scenarios are going forward. I kind of think, actually, we'll go to the fixed income chart, which is page 15 of the.
Can I get a quick question?
Yeah,
Ken,
sure.
quick
Go ahead.
question. This is Jason.
Hey, Jason.
I just want to make sure I understand. So you said the rise in the interest rates brings down the liability. Is that because we'd be getting more money on our fixed and bonds? Is that why?
No, in fact, the way that works is the cost of the future liabilities. If rates are higher, the cost of those future liabilities actually come down at a very low future cost of a liability. The lower the interest rates, the more you have to pay today in order to pay for that into the future. The higher the interest rate is into the future, the lower that future cost will be based on the liabilities today. So
because
got a
money's
liability. I'm sorry.
because money's cheaper compared to what it would be if we had higher interest rates.
That's correct.
Okay.
That's
I just want to make sure I understand.
Yeah. So there's different ways of sort of matching those liabilities to they call it the duration of the assets matched to the duration of the liabilities. You could go very long in terms of the duration of the bonds. The problem with that scenario is if you go very long with the duration of the bonds, the performance of that very long portfolio actually comes down as liabilities go up. So you want to be very careful in making sure that in protecting the liabilities, you're not damaging your assets at the same time. So it's a very complicated analysis, which is why it doesn't happen, in a big extent.
Yeah. All right, thank you.
Okay, great. Just as again, page 15 of the Sageview deck, page 49 of the Groton deck. This is the yield curve. As we look at it, the blue line is where the yield curve was at the end of June 30th. Again, this is what we call a normal yield curve, meaning that the lower the maturities, the lower the yields, and the higher the maturities, the higher the yields. You can see the blue line is kind of in between the other two lines, meaning that as of June 30th, rates were higher than they were at the beginning of the year, but lower than they were at the end of the first quarter. So we've got a little tug and pull. Again, normalized yield curve, that's good for the growth of the economy. That usually suggests that the economy is in a growth mode. However, we're not exactly sure where interest rates are going as the debate, over things like inflation, continues. And just wanted to, this I think is kind of an interesting chart. The next page 16 and page 50 of the deck. It looks at different areas of spending that the economy goes through and the impact that the pandemic has had and the recovery that we've seen. So things like travel, or let's look at U.S. seated dinners, or diners, so people going out to eat in a restaurant. At the bottom of the pandemic, the worst case of the pandemic, nobody was going out and eating in restaurants. So there was 100% loss in that. At the current levels, we've only had a 5% loss based on pre-pandemic diner usage or diner utilization. So you can see a tremendous recovery. People want to go out and they want to spend. Same thing with travel. We had an 82% drop at the low of the pandemic. We're now at a 4% drop, based on pre-pandemic. So point here is that people are anxious to go out and spend. As Roger suggested, there's a lot of pent up demand in the economy, suggesting certainly over the next year or two that we can continue to see the kind of economic growth that we've seen. The question is, at what cost does that come? Is that a cost of an inflationary scenario, and how do you ultimately correct that? What's the impact on that? So we just want to make sure that we're understanding that and designing the asset allocation strategy, consistent with that. So any questions on that? I want to briefly get into, just a kind of a summary of the funds in a second, but I just want to see if there's any questions on any of the information I've shared. Okay. So if we go to page 59 of the, 59 of the Groton deck and page 25 of the Sageview deck, this is again the funds that Roger had talked about. The ranking that we have from a governance standpoint, how the fund's performing is shown on the far right-hand column. And again, anything in green, as we've talked about in the past, is a passing score. So what we've got are 4 index funds, and we do a pass-fail on those, and all 4 have passed. And then we have 3 active funds, and each of the active funds are either in the top decile, top 10% of of other funds that you could invest in that asset class, or in the real estate in the top quartile. And so everything looks really good. The funds are performing as we hope that they would. And then if we finally go to page 61 of the Groton deck and page 27 of the Sageview deck, the average score, for the 7 funds that we're looking at is a 12. And again, the best you could do is a 1, worst you could do is 100. So, scoring in the top 12th percentile on average is very, very good. So really good performance on the funds that we have. Great asset allocation, has performed well. The assets are working. Ultimately, the question is, should we continue along this asset allocation route, or are there other strategies that we might want to at least look at and consider going forward? And that's what we'd like to bring to you, sometime hopefully before the end of the year. I'll be quiet now and see if there are any questions.
Hey, Ken, this is Mark, and this may not be the right time to ask this question, and this may not even be the right venue to ask it, but here I go. So you mentioned we're at 81%, and we've been around in the low 80s for quite a while at coverage. And so the hypothetical question is, in my mind, is, well, what would it mean if we were at 100% coverage? What impacts would that bring about? Besides the town, I would assume the town's annual contribution would be either significantly less or 0. But are there, and that's really a question too. I don't want to presume that I know the answers to any of this stuff, but there is a follow-up discussion I want to have. So what would it mean, if we were at 100% coverage? How would that impact our retirement program?
Yeah, it's a great question, Mark. There's really three different things that you could think about, and some may be off the table and some may be on the table. Generally, when you're looking at the more better funded you get, the impact that has on contributions is significant. It does lower the contribution levels. What that does for some plans is it gives them the ability to actually raise benefits, so that you can say, all right, we're better funded now. We're willing to pay the same dollars that we've been paying. How do we enhance the program so that the dollars that we're paying gives the participants a better benefit? So that, that's something, again, that you saw more back 30 years ago, when defined benefit plans were more, were more normal than they are here, both on the public side and the corporate side. The other thing that it does for some plans that don't want to be in a defined benefit mode anymore is that gives them a closer option to either freeze the plan, to terminate the plan ultimately, so the real extremes are, one, you can enhance the benefits of the program by paying the same amount in a better funded situation, or you can look to ease the burden of the town by either terminating the plan or lowering the benefits, either buying out some of the liability that you've got built up in the plan.
Okay, I wasn't really thinking, maybe it's just been my experience over the years. I wouldn't anticipate that the enhancing the benefits per se would happen, but it would lower, would it lower the town's annual contribution?
Sure. Yeah.
Okay.
I mean, again, what it does when you look at it, think of it, from when Hooker and Holcomb, make their presentation, what they're looking at is what are the current assets? What's the market value of those current assets? What's the current liabilities? What's the projection of those current liabilities? That's where the interest rate,
Yep.
Projection comes into play. And the closer those two are, the lower the future contributions have to be in order to get to that future liability number.
So where I'm ultimately going is I read with interest, and I haven't reached out and gotten any other information, but I believe the city of Norwich actually had contemplated or actually had done a bond issue to cover their shortfall in their pension program. And what I got out of the article, it's a pretty, to me, it seemed like a pretty simple analysis that could be done is, if we had to go out and borrow $35, $40 million, let's say for 20 years or for 30 years, what's the annual cost of doing that versus what is the town's cost on average, to fully fund the liability, which is called out for in an ordinance that was passed many years ago. And so I'm just raising that. Once again, this may not be the venue to have that discussion, but I was intrigued. I was particularly intrigued that Norwich was seriously considering doing this, and whether or not it's something that we either have looked at, for all I know, John and staff may have already looked at that, or is it worth pursuing at all? Or, we've got enough debt, the town, with all the school projects that the voters have approved. I would imagine this would be a tough sell, but if in fact you could show that instead of the town making an annual contribution of whatever it is now, $3-4 million, that it's some number significantly less than that, from a bond payment, whether or not that would be worth pursuing or considering.
Mark, I can, it's ironic that you're bringing this up. Mark and I, from Sageview, we're actually just talking about and this is more applicable on the corporate side, not necessarily the public side, where you do have the ability to issue bond, so you may have more opportunities, but with money being so quote unquote cheap today,
Yeah.
And so, if some companies want to get out of their DB plan, can they fund it through low interest rate borrowing kind of thing? So there is some interest on that on the corporate side, and it's something that we'd be happy to at least look into, the pros and the cons of that, and report back to you at the next meeting if that's of interest to the
Yeah,
I'd be
I'm
interested
certainly.
too.
I'm sorry, John.
I just said I'd be interested too.
Yeah, I'm personally not raising it so that we go down the path of getting rid of the DB plan. I think there's been enough changes made to that in my mind recently. It's really more to lower the town's annual cost And maybe it will do something, maybe it won't. I truly don't know. I would think it would, but I don't know that. And it's all premised on such the low interest rates that the town or municipalities have access to. Right, so my experience with these, and certainly I think Ken and his team should do some analysis, is in essence, because rates are low, you're borrowing today inexpensively. Your return on asset assumption is 7%, right? So if you fund up the plan, to your point, to get the 100%, then through time, you should have a lower cost of contributions because again, you have a larger asset base that's generating return for you. That's in essence.
And no major changes in the plan.
And again, just very simply, the cost of the plan, is what the liabilities are. That doesn't change, assuming that the benefit structure doesn't change. And how you fund that is either through contributions, through liabilities coming down, or asset returns. And so, you really can't control the direction of interest rates. You can't control where assets go, and the one thing you might be able to control is the contributions that you can put into the plan. So I think it's prudent to look at all of those avenues, especially when the cost of borrowing is relatively low as it is today, and to see is that at least an option worth pursuing or considering.
Just a
Thank
quick
you.
question. This is Jason. John, has there been any like a way to track? I know the hybrid plan was introduced a couple meetings ago. Is there a savings? Has there been a savings for the town?
It's really not been implemented yet.
Okay.
It turns out there's an ordinance for retirement, and it's very complicated. So our attorneys are still working through it, hopefully soon.
Okay.
Sometimes we gotta talk.
I was just curious.
Yeah.
So, and I think I'm hearing you'd like to learn more about this potential avenue at this point. Certainly, nothing to act upon, but it's more educational and to see if this is something at least worth pursuing going forward. Is that a fair statement? And would you like us to come back next meeting with more information on this?
This is Mark. I'll defer to John and staff. I was simply raising I think this is kind of an area that I don't know that the retirement board per se, this is their kind of in their roundhouse, so to speak. It was something I noticed. I haven't done a lot of research on it. To me, it would be worthwhile looking at, but I would defer to John.
It's at least, if you could take a look at it and give us, basics of the pros and cons, and we could see if it's worth pursuing further.
Will do.
Thank you.
Good. John, that's all we had for today.
Okay, thank you, Ken.
Okay.
Any other business? Do you have anything, Cindy?
I don't have anything, no.
Okay, now the next date is November 18th. Does that look, as of right now, good for people?
Yes.
It works for me. So as of now, we'll plan on that then. Is there a motion to adjourn?
I move we adjourn.
It's so moved.
Okay,
So seconded.
thank you. We'll just consider ourselves adjourned. Thank you.
Everybody.
All right, take care. See ya.
Stay
See you
safe.
soon. See you soon. Thank you.
Bye.